Albertsons faltering in its public trading debut after 14 years of private ownership. Shares of the American grocery chain failing to take off after a shrunken IPO. Bloomberg caught up with the president and CEO, Vivek, Sankaran, to discuss the IPO and his company's omni-channel approach during the crisis.
We are so centered on the long term. As you know, our investors have been with us since 2006, have helped build this company and strengthen it. We have momentum in the business, and we just felt the time was right. And when you have a long-term perspective, while I look at the ticker, I've been looking at it all day, I also recognize that we're building a company and strengthening this company to deliver value over many, many years.
Talk to us about strengthening the company, building the company. There are many that might say, look, e-commerce needs to get better. What about expansion plans in terms of ensuring that you maintain and grow that market share that you already have?
Yeah, no question about that. But we came together as Albertsons and Safeway in 2015. And the first few years was focused on integration, putting common systems in place and such. And then we switched to transforming the company. And transforming the company is all about putting new technologies, and one of those is our omni-channel solutions. And we give the customer many choices. You can pick it up in our store, we deliver it with our own trucks, deliver it with third parties, etc. And we continue to expand it. We think there's plenty of headroom. It's important to recognize that it's all in the early innings for all of us in the industry. And there's so much learning, so much piloting going on. And that's one element of strengthening the company. But there's also strengthening the company's day-to-day operations with technology, so we become more efficient, even in the stores where we do a lot of our business.
Yeah, I'm curious. You mentioned Safeway, obviously the big combination there, but I mean, under the Albertsons umbrella, Vivek, I mean, you've got a lot of different brands. Obviously, Albertsons, Safeway, Acme, Jewel Osco, which I grew up on. I didn't even realize it was part of Albertsons now, a great grocery store, by the way. I am curious, though, how seamless is it going to be for customers who want to use an Albertson app or use some sort of online delivery system from Albertsons if they're jumping maybe from city to city or from a different grocery brand to grocery brand?
Romaine, the first thing to recognize is these brands have been around for so long. Like you just said, Jewel Osco is a household name in Chicago. Tom Thumb is a household name in Dallas. So we're proud of those banners, and those banners mean a lot to people. And they all have this little nuance that's a little different, that's tailored for that customer. When it comes to our e-commerce applications, our loyalty applications, you'll see the back end is the same. The front end is different. So you feel like you're on Tom Thumb, but you're on the same infrastructure. When you move from city to city, you carry your loyalty points. Now, and you carry everything that you bought, all the data we carry with you. We're working on making those interfaces even better. It's a big part of our agenda. You know, that never stops. We're always trying to figure out how to make it easier for you to navigate and order with us. It's a journey that never ends, and we put more energy into it.
Our analysis shows a debt load of almost $9 billion. Grocery stores notorious for just being a very low margin business. In the middle of a pandemic, how do you think about boosting margins and reducing that debt burden?
Our debt load is now 2.4 times our EBITDA, which is a good place to be. Our program is continue to reduce that from the cash flows that we get. It used to be much higher. It used to be more like 4 times EBITDA, and we brought that down significantly over the years. And so we're not debt constrained. We're not capital constrained. Let me put it that way. And we can take a very measured approach to pay that down, and then get to the right balance of debt and equity to fund the company.